Hello.
All right. Can you hear me, Alfred?
Yes, I can hear you.
Great. All right. Blake, you should have the ability to unmute yourself now. There we go.
Yes, I'm good.
Perfect. I will. I have the presentation here. I can.
Okay. Let's see. Okay, and you tried to share screen. Does it give you that ability yet?
No, it still says host disabled.
Okay. Oh, it's not allowing me to make anyone a host. Let me. Okay. Let's see here. Give me 1 second. Seems here we have someone else in our office is also on here, so that's what's keeping me from doing it. Just give me 1 second. I'll be right back.
Okay.
How are you today, Alfred?
Good, sir. How about yourself?
Doing well.
Excellent. I will just try to follow your lead in moving this forward.
Okay.
Let's see here. And if you want to refer to any slide title, I can get back to it quickly.
All right. That should be fixed now. Let me find it. There we go. Make co-host. All right. You should be able to now, if you go to share screen, you should have that ability.
Let's do this. Share presentation. Okay, let's see if
Great. We're still waiting for John here, and we still have about 12 minutes or so until we're scheduled to start. So we got plenty of time.
get this going here. All right. Once it gets started, I'll probably just turn off my camera so no one has to look at me.
Yeah, I typically do the same thing, but I'm like, the Wizard of Oz, you know.
I was going to ask you, Alfred, when was the last time you had a haircut?
Probably 2 weeks before we took off.
Yeah.
We're in negotiations right now to see if I can make it to a barber.
Yeah, I was going to say that when yours gets long, it curls up, doesn't it?
Yes, it does. It does.
Mine did the same thing. It took me about 3 months before getting a haircut, and he didn't exactly do it to my preference, but I was just happy with everything.
My wife is getting scissors and getting antsy, so I don't think my hair's been this long since college. So,
Well, are you both in the San Antonio?
yes, we're at San Antonio branch here.
So is it now the case where anywhere you go, any business you go into, you're going to need to wear a face covering?
Yeah, that just went into effect.
Just want to do that.
Yeah, our county judge put that into effect yesterday, and the governor indicated he will not block that order. So
It seemed like he left that there the way he worded it. He left it for someone to figure out, and he said that the judge finally did a good job of not basically circumventing individual freedoms. Oh, well, if you come to a business, you have to wear stuff.
yeah, but at the end of the day, it's if we don't deal with the public health piece of all of this, the economy is never going to recover. And so what I don't understand is why wearing a mask has become such a political issue.
We were discussing it in our office today, and that's, if anything, a small price to pay, reopening the economy.
Yeah, I agree. In fact, I heard some interviews with local business owners last night that were complaining that now they have to worry about, policing whether people are wearing masks or not. And I'm like, I'm sorry, but I'm not very empathetic with that argument. That's not a difficult thing to do for most businesses. And, you know, the consequences of not doing it are pretty, you know, can be pretty bad. I mean, and this is not a political thing. It's based in scientific evidence, right? I mean, they have studies that prove wearing a mask reduces your chances of spreading or catching it by like fivefold. So, I mean, I don't get where the political argument is here at all. I mean, I understand the political freedom thing, but public health, I think, supersedes.
Definitely.
Anyway.
Hey, Blake, John's on.
John, how are you today?
Drying out. We had a huge rainstorm here. Probably had, I don't know, 3 to 5 inches in about an hour and a half.
Wow.
Yeah, it was
That's
incredible. The weathermen never called it. It just blew up about 10 o'clock and rained till, yeah, wild. A lot of
Well, we're in the dry season. We had a little tease of rain this morning. It lasted for 3 minutes.
Yeah. Yeah. No, it was pretty spectacular. We won't complain.
Yeah, we need it.
How are you?
So you've been doing okay, John?
Yeah, we're things are. I don't want to say stabilizing yet for the chamber individually, but we're making progress. I'd put it that way. We're not in the hole we were in April. Things are starting from our financially and just what events we're trying to do. For instance, we were one of our big revenue generators are these special events we do, like State of the City, State of the County. You know, everybody does those chambers. And our State of the City was postponed because it was right in the middle of March. And we just met with the mayor yesterday and got tentative approval to do it, but we're going to do it. We're going to do it at the Whataburger Field outside, so we don't jam people in, and we got plenty of space for social distancing. We're going to do it at about 6 o'clock at night and have kind of a baseball atmosphere, even though there's no hot dogs and hamburgers and popcorn, and it should be cool. The mayor's excited about it. The Hooks were very interested in helping us, so we'll see what happens, but we got to do something. We can't just sit in the show. So yeah, we're getting there. But we've had a spike in positives in Nueces County the last, I don't know, Tristan, what would you say, 5-7 days?
Yeah, I would say, not dissimilar to other areas and as well. But
our spike is, before we were at 5 or 7 a day. Now we're in
we got 28 today.
Every day. So it's a concern, and I was, since we're not on the air yet, I was really pleased with what Judge Wolf did with just kind of forcing the issue on the masks in business.
Oh, I'm sorry, Blake. Like the way it's set up, if you mute yourself, you're not going to be able to unmute yourself. The only is if I give everyone the ability to.
I see. Okay, I will not mute myself again.
Yeah, I've learned that when you do it, then you're getting a panic and you.
Yeah, I had a moment there, John. I was like, uh-oh.
In the chat, otherwise,
I had a moment. Yeah, no, I was very happy that Judge Wolf kind of pushed the issue, because I frankly, John, I was telling your colleague here that I just don't understand why this is a political issue. Yeah.
And I don't know why and this is somewhat political, but I don't know why the state is trying to take this to the major cities. I mean, Houston, Dallas, San Antonio, Austin, Corpus Christi, El Paso, ought to be able to make their own decisions. They're there every day and know what's going on. It shouldn't be somebody in Austin deciding
Yeah.
you don't. That just doesn't make any sense.
Well, and then, there's scientific, research and evidence that shows that wearing a mask reduces the transmission by like 5 times, by 5-fold. So I don't understand why, especially given the number of cases are spiking, particularly in the major cities you just listed. I don't understand why you wouldn't want to, wear a mask and prevent the spread, or at least slow the spread. But
It's
yeah,
it's not
strange
that
argument.
position to put on a mask when you're going into, I mean, it sounds ludicrous, but businesses can say have to wear shoes or a shirt.
Exactly.
They ought to have the same freedom to say, you don't come into my place unless you have a mask on. If you don't like it, go somewhere else.
The analogy that I was using for some people the other day is, we require people to have car insurance. If we left it up to them to do it, well, we know what that looks like because we lived it for decades, right?
Yeah.
The number of uninsured motorists was a real scourge on those who were insured. It cost everybody more money. So, yeah, I'm all about personal responsibility to a certain point, but when it affects other people,
And this certainly does.
Indeed.
What time do we have? We've got about 3 minutes. We'll start on time and finish on time, Blake, so we don't.
Okay. And are you guys getting my video okay, or?
Yes.
Yeah.
Okay, perfect. I just can't see myself here, so.
No, it's all good.
Blake, can you
Well,
see,
John,
see the presentation though?
yeah, I can see the presentation, and I can see you in the bottom right corner. That's good.
Hopefully there's no lag, so I'll try to keep up here.
I see that President Kaplan's having the webinar or something next week. I signed up for at 5 o'clock on COVID-19, I think.
Yeah, I believe we have an epidemiologist that he's going to be talking to, and I think one of the messages we're trying to get across to people is that there's no way to separate the economic outlook from the public health, piece of it. And I'll talk about that in the presentation today, but it's pretty evident that the public health aspect of this is affecting behaviors of businesses and consumers alike. And so, we're not going to see any sort of return to normal until the public health issues have been resolved, or at least resolved enough to give people confidence to return to normal. So it should be an interesting dialogue.
Yeah, I say that's a good way to do it. Well, you guys have certainly had an active 3.5 months, haven't you?
That is an understatement. That is an understatement.
I don't think you've ever been in the news as much as you have in that time. I mean,
Yeah, we were back during the financial crisis.
Yeah, 08. Yeah,
yeah, especially around the Lehman Brothers collapse. That was a time where we really, things really took off and we got super busy. But this, that's the closest thing we have to compare it to that's recent memory. But this far supersedes that. We've had to do everything we did then times 2 or 3. This has just been a highly unusual. There's no playbook for this.
No, well, nobody has one. It's a interesting time.
Indeed.
You about ready, Tristan?
Yeah.
Another minute. 2 o'clock by my computer.
I'll make a note of it though before we start. For those currently on the call, if you have any questions you'd like, or any questions you come up with during this presentation, don't hesitate to either type them in the chat if you're on Zoom, or via phone. You can email them to me directly at Tristan. That's Triston at unitedchamber.com. I'll be happy to ask those questions at the end of the presentation. Again, I will type this all out in the Zoom chat, but you can either send them in via Zoom directly to me in the chat feature, or email them to me. So that's all I have, John.
Okay, I'll get started. Welcome, everyone. Thank you for joining us for our continuing series of webinars trying to keep the business community here in our region informed of what's going on and how you can keep your business alive and well, and how we can help you in any way that we can. And today we've got Federal Reserve Bank of Dallas, who's a senior vice president, works out of the San Antonio branch of the Federal Reserve of Dallas, and we're going to talk about the economic impact of the COVID-19 and the Fed's response to it. And we were just talking briefly that the Fed has really taken on a very strong role in this situation we'll find ourselves in. Much stronger, I think, maybe other than the 2008 crisis that we had, but even more so than that, they are taking a strong leadership role and really doing everything they can to keep our economy on course, and that means our businesses open and our people who live in our communities working. Everything from what they've done so far in the Main Street program that's coming up. So I've known Blake. I'm trying to think, Blake, how long we've known each other. It's been 15 years, more?
Yeah, 15, 20 years at least.
20 years. I first met Blake when he was working in San Antonio for the Free Trade Alliance. And I ended up getting on that board and did a great job there, and was able to move on to the Fed. But a strong background in South Texas, knows our institutions and besides the rest of the state and the rest of the region that the Fed covers. Has a bachelor and a master's degree in international business from George Washington University, D.C., and I'm really glad he was able to come on and take some time to tell us what's going on. So Blake, we're going to keep this right to an hour. That's one of the things we try to do when we get our guest speakers to come on and participate, that everybody's got plenty to do these days with Zoom meetings and other things. So we'll keep this to an hour, and we'll take the questions, and what you can answer on this we'll get you for and put up on our website. So Blake, go ahead.
Thank you, John. Thank you very much for your kind introduction. And it is a pleasure to speak to you and the members of the United Corpus Christi Chamber of Commerce. Thank you for the invitation, John. I appreciate it very much. What I'd like to do for you today is as John kind of outlined, is talk a little bit about what we're seeing happening in the economy, provide you a little context up front to give you kind of a baseline of where we were before the crisis, so that you can kind of fully understand the impact the crisis has had. And then talk a little bit about the Fed's response, and then sort of the outlook going forward, what we see. To give you a sneak preview of that, obviously it's everybody's crystal balls are a little fuzzy and gray right now, because there is no playbook for dealing with a pandemic, at least in modern times, and what the response, the economic response to that is. So we're learning as we go, but I think there are at least some silver linings developing on the clouds right now, and giving us some pretty good reason to be optimistic that we may be in the midst of that recovery that we're all hoping for. So with that, I'll go ahead to the first couple of charts here. One of the things that I want to emphasize up front, and I think it's very important, is that as I speak to you today representing the Central Bank of the United States, we sometimes, using our charts and graphs, can get technical and kind of give kind of give you a picture from 40,000 or 50,000 feet. And sometimes we can come across as though we're maybe a little detached from what's happening on the ground, what's happening on Main Street. And I want to emphasize to you today that nothing could be further from the truth. That is actually a big part of why the Federal Reserve System exists. In fact, if you'll go to the next chart, you'll see a map of that system. And this was created in 1913 as a way to decentralize the central banking function of the United States and make sure that Main Street was represented in the making of our nation's monetary policy. And so a big part of my job and my colleagues' jobs that are also listening in today, representing the San Antonio branch of the Dallas Fed, is to be on Main Street, is to talk to business leaders, like many of you that are on today's webinar. So I spend time talking to John and many of you in the membership about what's happening in the economy. And so do my colleagues, are not only around the 11th district that you see on the map there, covering Texas and northern Louisiana and southern New Mexico, but in all of the other 11 Reserve Bank districts. We're constantly talking to business and civic leaders on a regular basis. And I think that's important, particularly in a time like this, because one of the things that we realized early on in this crisis was that the engine of job growth in this country has and always will be small business. More than 80% of jobs in the United States come from small business and are created by small businesses. And it was very clear early on in this crisis that we needed to make sure that we were doing what we could to help the smaller businesses, because we have a dual mandate at the Fed of making monetary policy that creates an environment for stable prices, meaning no inflation or deflation, but also maximum sustainable employment. And one of the fears we had was that we couldn't do the second part of our mandate if small businesses started going under and there were no jobs for people to return to. So talking to small businesses, talking to business leaders throughout the country is a vital part of how we conduct monetary policy in normal times, but it's probably twice as important in a time like this when we're going through such an unusual set of circumstances. The other thing I want to emphasize is that we recognize there's a human aspect to COVID-19. Certainly the health aspects of that for people who are getting sick, and unfortunately for families who've lost family members due to the virus. We recognize that it's very easy to talk about this at sort of a high macroeconomic level, and kind of lose sight of the human aspect of this, the human toll. And I want to let you know that we are not only very sensitive to that, but we're living it too. We understand the impact that COVID-19 can have when someone catches it. We've lost some of our own members of the Dallas Fed family to the virus, so it is personal to us as well. And I want to make sure you understand that when we're thinking about these issues and topics that I'm going to talk about today, behind the backdrop is a keen understanding and awareness of what's happening on Main Street, and more importantly, what's happening at the human level due to this pandemic. And the other thing that we're also aware of is what else is going on right now in our society. I think it's important to note that some of the social issues that have emerged in the last few weeks, with the unfortunate death that we saw in Minneapolis, and the protests and things that have emerged since then, we're not being shy about talking about that either, and putting out our thoughts about what this means, particularly to the economy. And the one thing I was very proud of our president, Rob Kaplan, when he said on national TV the other day that racism, systemic racism, is a problem, and it is hurting the economy. Until everybody can participate in the economy equally and equitably and fairly, the economy will not reach its full potential. And so dealing with systemic racism is certainly an issue as it relates to our social construct and to just a sense of what's free, what's fair, but it's also an economic one too. And I think at least it's our responsibility at the Dallas Fed and across the Federal Reserve System to acknowledge that and to talk about it. So I wanted to put that out there as a beginning point, just to provide some context for you for how we at the Dallas Fed are looking at the world today. Those are certainly factors that we're aware of and that we're keeping in mind as we look at the economy. If you'll go to the next chart, you'll see the map of the Dallas Fed District. My colleagues and I represent the San Antonio office, which covers all of Central and South Texas, which is shaded in the lightest color of blue there. You can see the territory covered by our Houston office to the east, our El Paso office to West Texas and Southern New Mexico, and of course the home office in Dallas that covers Northern Louisiana and Northern Texas, just to give you an idea of our regions that we cover. If you go to the next chart, you'll see the representation of the types of folks we talk to on a regular basis. This just happens to be our board of directors at the San Antonio office. And you can see Al Jones. Many of you on this video conference know who Al is, and he's been a pillar of your community for years, not only running American Bank based there in Corpus Christi, but the civic service he's done for the board of Corpus Christi and other things that he has done. We also have folks like Gabe Guerra, who I believe is on the video conference today, who's involved in one of our advisory councils that we talk to. And we do a number of roundtables and other advisory councils all across our territory on a regular basis. So these are just the 7 women and men that serve on our board, but you can multiply this by about 2 or 3 dozen, and you'll get a sense of the kind of people we're talking to all across not only the San Antonio branch territory, but the Dallas Fed territory more broadly. These are the folks that help us stay in touch with what's happening on Main Street. And so I think the biggest takeaway from this is to understand that the Fed cannot function its duties as the central bank of the United States without this public-private partnership. And having folks like Jesus, like Tyson, like Al, and the others telling us on a regular basis what they see happening in the economy and providing us their thoughts and insights on monetary policy. It's vital to the functioning of the Federal Reserve System. And you can multiply that by 30 because that's happening at all the branches and home offices across the country on the previous map that I showed you. So you get a sense of the strength of the Federal Reserve System is truly this partnership we have across the country with business and civic leaders. Next chart. So, what are we doing to kind of help businesses get through this crisis? I'll talk a little bit about it at the end of the presentation more specifically, but one of the things that we're really trying to do is understand what's happening with consumer behavior and with businesses. But in order to really kind of understand the crisis, I think it's important to take a step back, if you'll go to the next chart, and kind of see where we came from. And this is a nice sort of timetable that gives you a sense of some of the major milestones that occurred during the COVID crisis. And what you'll see is that what started off as a supply side shock when the virus first broke out in China, causing the Chinese to shut down factories that supplied goods, services, and supplied goods and components to U.S. retailers and U.S. manufacturers. That supply side shock, once the virus spread across the globe, including to our own country, quickly became a demand side shock when we went to a shelter in place type of posture in our country. We began shutting down businesses, including factories. And so consumers began pulling in their horns and saving their money and stopped spending as much. And so suddenly what was a demand shock turned into a supply shock, literally in a matter of a couple of days. And with that came the inevitable financial shock that was sort of destined to follow. So literally in less than a week, we went from a supply shock with China being sort of out of business to a demand shock here in the US and then a subsequent financial shock. We, through an emergency meeting, an unscheduled emergency meeting, we lowered the Fed funds rate March 3rd just to kind of begin moving quickly. And you can see that after we declared a national emergency a couple of days later, we went ahead and lowered the Fed funds rate, our primary tool for monetary policy, all the way to 0. So we basically opened the monetary policy spigot as wide as it would go. And then since then, we've begun, much like we did during the financial crisis, we've been releasing a whole series of liquidity and lending facilities to first and foremost, make sure the financial sector was healthy and able to conduct business as usual. Because we learned from previous financial crises that if the financial system's not functioning properly, there is no transmission mechanism for monetary policy. We cannot stimulate the economy back to recovery if there's not a good banking system getting credit out to businesses and consumers. So we began, like we did during the financial crisis, doing things to make sure the financial system was shored up. And then quickly after that, we pivoted and began actually doing programs that legally we could not do before the CARES Act passed Congress back in March. And that is directly lending to businesses, to municipalities, and state and local governments more broadly. And we've begun those programs, and I'll talk a little bit more about them. So you can see on this timetable, we reacted pretty quickly, and we've reacted pretty broadly since the crisis began. To give more context, in the next chart, you'll see sort of the expansion that we were enjoying before the COVID-19 pandemic broke out. The expansion that began in 2009 as the financial crisis was sort of coming to pass. This expansion, as you can see kind of by looking at it over the quarters on the bottom axis there, was the longest expansion going all the way back to the 1950s. In fact, if you go back even into the 1800s, this is the longest expansion on record in US history in terms of the length of the expansion. But you'll note in terms of the sort of steepness or the size of the expansion in terms of percentage growth in the economy, it's actually been the weakest that we've seen since 1950. In fact, if you look at this chart, you can see the very noticeable pattern that each financial recovery, each economic recovery and expansion after recessions have been getting weaker and weaker progressively, starting with 1991 and then 2002 and 2009. And a big part of that is some basic realities to the structure of our economy. And one of those big realities is that we have an aging workforce, and we have a slowing of the workforce growth in the United States. And two things grow the economy: workforce growth and productivity growth. And so in the US, we've essentially been fighting for the last couple of economic expansions now with one arm tied behind our back as labor force growth in the United States really becomes weak. In fact, just to give you a reference point to that, where we sit today, the contribution of native-born Americans, those being born to Americans who were also native-born, they are actually having a net negative contribution to labor force growth right now, and will for the foreseeable future. Simply put, Americans are not having enough children to replace themselves, if you will, in the workforce on a consistent basis. So all of the workforce growth we've had over the last number of years, or the majority of it, I should say, and all of it going forward for the next couple of decades, will be from immigrants and children of immigrants. That's really the only thing continuing to fuel the labor force in the United States today. And that's not unique to our country. You're seeing this throughout Western Europe. You're seeing it in Japan. You're seeing it in China, where they had a one-child policy for 70 years. These demographics are really starting to kind of take a bite and cause just generally slower growth across those economies. The next chart will kind of give you a sense of where the labor markets were leading into this. As I said before, we have a dual mandate of stable prices and maximum employment. By almost every measure, we were exceeding our mandate for maximum employment over the last number of years. As you saw, the unemployment rate dipped below what we estimate to be the natural rate of unemployment. So arguably, we were not only at full employment, but we were somewhat past full employment. Yet we didn't see inflation spike up or get carried away. And there's a lot of factors for that I can talk about if you want to get into that in the Q&A. But suffice it to say, before the COVID-19 outbreak, we were doing quite well in the labor market. And then you can see things dropped off the cliff. The unemployment rate spiked up officially to 16.5%. And in the most recent reading in May, the unemployment rate came down to 13.3. I will tell you that 13.3 number surprised every economist in the country. Everybody thought, due to the large number of unemployment claims that were continuing to be filed in May, that everyone expected the unemployment rate to go up from 16.5% to something closer to 21%. So we were all pleasantly surprised when the number actually came down. In fact, 2.5 million jobs were recovered in the month of May from those that were lost in April. And we were estimating that we would actually see a 7.5 million job loss in the month of May. So economists got it dead wrong. Everybody was pleasantly surprised that instead of losing 7.5 million jobs, we actually gained back 2.5 million. So that's a 10 million job swing and a pretty significant surprise. If you correct for errors in the data that the Bureau of Labor Statistics acknowledges are there, the actual unemployment rate in April would have been closer to 19.5%, and in May, closer to 16.4%, but still moving in the right direction, coming down, not going up. So I think that's the big takeaway. So this is an early indicator that maybe some of the worst is behind us. That's not to suggest that all of the pain is behind us, particularly from a human aspect. There are still millions of people filing for, 1 million plus people filing for unemployment every week. The numbers that came out, I think it was today, we saw 1.2 million Americans filed for unemployment last week. That's a really historically high number. In fact, if you look at it on this chart in a historical context, you can see that at 1.5 last week and 1.2 this week, we are still seeing jobless people filing for unemployment benefits at record levels that we have not seen going back 30, 40 years. Looking at it on the top chart here, the smaller chart at the top of here, you can see that same trend just in this year. And again, you can see when the shelter-in-place orders went into effect, the huge increase in the number of unemployment claims, and that has steadily come down, but still at an elevated level by historical standards. So it's something to watch. But for the jobs that were lost in the month of May, more jobs came back than were lost, to the tune of 2.5 million. So some volatility for sure, but positive signs nonetheless. Moving on to the next chart, you'll also see at the Dallas Fed, traditionally we look at monthly and quarterly data on the economy, which always comes out with a lag and is always subject to revision. So at the Dallas Fed, given that we went into a pandemic and really needed to be able to track the economy in more real time, we came up with a weekly economic index. And by our estimates, the weekly index showed that in April, the GDP dropped by something on the order of just under 12% year over year. So the amount of economic activity we lost was equivalent to a 12% drop in overall economic activity. And for the last week that we have the data for, which was last week, that number's kind of bounced up to 10.5% or 10.6%. So still very negative, but again, bouncing off the bottom here and showing signs of recovery. Anecdotally, as I talk to business leaders throughout South Texas, and my colleagues do, and our economists do, we're hearing a lot of positive signs. In fact, I'll share with you the numbers that I got this morning on one of our board calls. So these are fresh. But at the Dallas Fed, we actually, along with other reserve banks, have been putting out some initial forecasts for where we think things might end by the end of this year. And we've actually revised our estimates upwards, in a more positive direction. A few weeks ago, we thought the economy would drop by probably somewhere on the order of 6% year over year, meaning that for the year total, 2020, that we would see 6% less economic activity than we saw in 2019. We've revised that and improved that a little bit. We think that right now at the Dallas Fed that the decline will be something closer to 4.2%. So still negative, still a very stark number. But if you'll go back and look historically at the Great Recession, 2008 and 9, you'll see we got around that 4% figure. So we're thinking things will improve. We will not see, we will not get back to economic activity that looked like what we had a year ago, but we'll be improving as the year goes on. And we certainly expect the third and fourth quarters will see positive economic activity compared to what happened in the second quarter. Positive relative to the second quarter, not necessarily positive relative to last year's third and fourth quarter. So a decline, but a decline that seems to be improving and moving in the right direction. Now that 4.2% number that we're forecasting at the Dallas Fed, we're an anomaly. We're a little more optimistic than the other Federal Reserve banks. The average of their estimates is that they believe a decline of 6 to 7% is what they're expecting. But we're seeing a lot of positive signs. We're hearing a lot of positive anecdotes from businesses. And so our forecast is more on the optimistic side, thinking that we're going to have a little bit stronger recovery. I want to emphasize that when I say that, one of the big caveats to that forecast is that we don't have a second wave sometime in the late summer or fall that causes another round of economic stress like we saw in late March and April. If that were to occur, then our forecasts would obviously be revised downward pretty significantly, something to on the order of a negative 8 or 9% loss of GDP activity. The unemployment rate, we at the Dallas Fed, we think it's going to end the year somewhere around 8%, which is still very elevated. A lot of the other reserve banks are forecasting 9%. So we're, again, a little more optimistic about that. But again, nowhere near the 3.5% unemployment numbers that we saw prior to the pandemic breaking out. So it's going to take us some time to recover from this crisis. And there's a lot of unknowns here. And I'll talk about those in coming slides. So moving on to the next slide. So let's talk a little bit about Texas. So the good news is, the bad news is that Texas appears to be more vulnerable to this particular pandemic and the economic consequences of it than the rest of the country by a little bit. However, the good news is that that has yet manifested in the numbers. So we're not seeing this materialize yet, but I think it's still important for us to be transparent with you and show you what our research indicates. And what we're looking at here is we have greater exposure in Texas in terms of the percentage of jobs in Texas employed in these industries that are most being impacted by the COVID-19 pandemic. Leisure and hospitality, obviously the mining industry, and you can see sort of the others. So we do have a greater exposure to the most impacted industries. And we do believe that, that could cause Texas to actually see an unemployment rate that's higher than the rest of the country. So far, that has not been borne out, and that's the positive news. And we think that that's being buffered by the fact that Texas is just a pro-growth state and has a relatively young demographic compared to the rest of the country, and a pro-business climate. So those factors may be offsetting the exposure that we have here. The other thing that's not on this chart that I'll talk about is we've done some research at the Dallas Fed. It's actually quite interesting. And we've estimated that the number of jobs in Texas that lend themselves to working from home, remote working, is about 2 percentage points less than the rest of the country. What does that mean? It means we have fewer jobs that can work from home than the rest of the country. And so that also gives us some exposure to the pandemic. Not a huge difference, but 2% is 2%. So that's another reason why we feared early on in this crisis that Texas could actually see a bigger hit in terms of jobs than the rest of the country. So we're going to continue to monitor that. We're going to continue to be aware of this. Again, so far it hasn't materialized, but I think it's important to point it out that we do have some vulnerability here. Moving on to the next chart, you can see where the layoffs have been here in Texas. It's across the board. It's hitting all sectors. It's hurting arts and recreation, food services, and certainly the hotel industries. You're seeing it in mining. I don't have to tell people in Corpus Christi that the price of oil is very low relative to where it was prior to the pandemic, and that has really had a chilling effect on drilling activity here across the entire state of Texas, particularly those regions that feed into Corpus Christi's oil and gas industry. So you can see across the board, it's been pretty hard hit, and it's certainly affecting those industries that I showed you on the previous chart are most vulnerable. So we're seeing that vulnerability certainly take place, but not any different than what we're seeing across the country at this point. Next chart. Looking at the Texas Leading Index and looking, and this is a chart that many of you who know Keith Phillips, who's our economist in San Antonio. He's one of the best regional economists, frankly, in the country. He has a great index that he uses for forecasting the future of the Texas economy. In the 13 years that I've been working at the Fed, and Keith tells me in the 30 plus years he's been working at the Fed, this index has never been this negative. All aspects of the index are negative. That hasn't happened in a long, long time. And when you add it all up, it's a pretty negative number. So what does that mean? It means that we expect job growth in Texas to be negative this year. And that means a higher unemployment rate. So not a surprise, but what it is showing you is that even though the energy sector only represents about 2.5% of jobs in Texas, it has a disproportionate effect on the Texas economy. So when oil is down in Texas, we tend to grow slower than the rest of the country. But when oil is up, we tend to grow faster than the rest of the country. And certainly right now, oil is down. And so that's certainly going to be a drag on the outlook for the Texas economy. So something that bears watching, particularly for our regions of the state that have larger concentrations of energy like Corpus Christi. So something to watch. Next chart. The good news is when we look at our outlook survey, so this is looking into the future and asking businesses both in the manufacturing space as well as the service sector space. When you look at this chart, the red line is the manufacturing sector and the blue line is the service sector. You can see the huge drop off in April that occurred. And you can see that while it's still very negative, it's rebounding. Anything below zero here indicates a contraction in the economy for those sectors. And of course, anything above zero indicates expansion. So while the outlook surveys are still pointing to contraction this year for our manufacturers and service sector companies here in Texas, the level of that negativity is certainly coming off the bottom, if you will. And we expect this to continue to move upward just because anecdotally, as we've talked to businesses over the last few weeks, more and more optimism seems to be coming back. And I wouldn't call it overly optimistic. I think it's still cautious, but people feel a lot less worse about things today than they did back in April and late March. And so positive signs to be sure. Next chart. So kind of looking at Texas, we have tailwinds and headwinds. I mentioned some of these tailwinds before. We have a very pro-growth state. We have pro-growth policies in our state. We have, plenty of developable land, an overall just fantastic business climate that has served Texas well for 30, 40 years. In fact, for 30 plus years now, Texas has average job growth. It's a full percentage point faster than the rest of the country over that 30-year period. So we are a growth state and we will continue to be one. And that is certainly something that's helping us through this period and will certainly help us during the recovery and hopefully expansion that follows. But we do have a lot of headwinds. Oil prices, as I mentioned before, have an impact on the Texas economy. Less remote work capability that I also talked about before is going to be a headwind. And we have more vulnerable industries. We're also exposed to international trade. And I think it sort of goes without saying, particularly to an audience in Corpus Christi, that the Texas economy, which you all know is the largest exporting state in the United States, has particular exposure to trade as the largest exporting state. And of course, a lot of that trade is with Mexico. And a lot of that trade with Mexico are in some of these industries that are being impacted, like the auto sector, for example. As Americans go out and buy fewer cars and some of the things that the maquiladora industries and other manufacturers in Mexico are supplying, either components or finished products to us, we're seeing that trade volume and trade activity decline. And that's also an exposure, particularly to South Texas, particularly to our border communities. So we're going to have to watch that. But this is not caused by the pandemic. It's not even caused by any policies because the border remains open for trade. But what it is a reflection of the overall slowdown in economic activity. And when the economy slows down, trade slows down, and usually it slows down by a little bit greater percentage than the overall economic slowdown. So something to watch, and it's certainly an exposure that creates a headwind for the Texas economy looking forward. That being said, going on to the next chart, we've done a lot at the central bank to respond to this. And if you look at the next chart, I'll give you a sense. A central bank in a time of crisis has one primary responsibility. And this is actually a playbook that was written back in the 1600s by a gentleman by the name of Walter Bagehot, who was sort of one of the godfathers, if you will, of central banking. And it really, the job of a central bank in a time of crisis is to lend everywhere and anywhere it makes sense to, and to sort of lean into the breach or step into the breach and make sure that credit continues to flow when an otherwise perfectly healthy financial system is unable to do so because of fear, because of panic, because of stress or strains that are caused. And certainly this sort of black swan event of a pandemic created that. So, early on in the crisis, we saw there were concerns about solvency and liquidity, and that's why the Fed stepped in and immediately began responding to that, making sure that banks had plenty of liquidity, had access to our discount lending window to access additional liquidity if they needed it. The last thing we were going to do is let the credit markets of the United States seize up and cease to work, because that would just take an already bad situation and, of course, make it impossible to recover from. So the next chart, I'll give you some specifics as what we did there. So our first tool is, of course, to cut the Fed funds rate. That has an effect on interest rates of all types. So all forms of borrowing, can be influenced by the Fed funds rate as well as the Treasury rates, and we saw those come down quite nicely, and that has a stimulative effect on the economy. But for that to work, we have to have a financial system that's functioning properly and credit channels that are getting that credit out to businesses and consumers. And so one of the things that we did to sort of restore market functioning to these kinds of funding activities, these credit activities, was to be very targeted. So for small businesses in particular, you all are familiar with the Paycheck Protection Program. I'm sure many of you may have taken advantage of this program. It was put together by the Treasury and operated by the Small Business Administration. But what you may not know is that we helped support the PPP program by providing a lending facility to banks who were making PPP loans. Banks were able to get additional credit from the Fed, additional liquidity from the Fed by taking their PPP loans they made to small businesses, using them as collateral to further borrow from the Fed so they can make more loans, make more PPP loans to small businesses. So in a way, we acted as a multiplier, a force multiplier, if you will, for the banking system to support the PPP program. It's a nuanced thing, but I think you get the gist of it. We were there to really help the banking industry, take full advantage of this. So as many small businesses that wanted and needed to take out PPP loans could. Recently, we've just launched in the last few days our Main Street lending facility that's targeted to both small and medium-sized firms. Many medium-sized firms were sort of left out of the other programs, so we wanted to make sure that medium-sized firms also had an opportunity to borrow. We're in the process right now of certifying lenders for this program and getting this up and running. But the idea here is that we're going to have the opportunity for banks working with the Fed to lend directly to businesses, particularly small and medium-sized businesses that meet certain requirements. The difference of the Main Street lending program versus the PPP program is that, unlike the PPP program, this is strictly a loan and it must be paid back. And so you can see here some of the terms of the PPP program on this chart. Range is from $250,000 up to $300 million in size. When we first announced this, we announced that $1 million was going to be the smallest loan we would do. We got a lot of feedback from chambers of commerce, from businesses, from elected officials. And so we've lowered that range to try to include as many businesses as we could. Why don't we lower it any further? Simply put, we don't have the staff to be able to process the volume of loans that would come if we lowered this any further, or the capacity, technological capacity to handle that kind of volume. We've never done any direct lending before. We were not legally able and authorized to do direct lending before the CARES Act passed in March. So this is a new ballgame for us. We've literally had to build an infrastructure to do these programs that didn't exist before. And so this is all kind of new territory for us. And if you go back to the previous chart, I'll talk about a few of the others. So we've done a lot in the large sort of firm space with a commercial paper funding facility, as well as operating in the primary and secondary market for corporate bonds. We're buying corporate bonds that are being issued directly by corporations, as well as those being sold on the secondary market. And as I said before, we're also lending to municipalities, state and local governments, to assist them with their sort of funding needs as their tax receipts and revenues have now become very inconsistent. We're allowing them to borrow, through our municipal liquidity facility to kind of help them smooth out their activities and giving them 3 years to pay back those loans, which is a pretty long period of time. And then we also have our term asset-backed securities loan facility. This sounds like a lot of gobbledygook probably to many of you, but what this really is helping lending of every type. So your credit card loans, your student loans, your auto loans, your mortgages, many of those, once they're made, get securitized, grouped together, if you will, and sold as a security in the secondary markets to investors. For example, 100 mortgages may be grouped together and turned into a security and sold off to investors for that return on those 100 mortgages. What we're simply doing here is making sure those those securitized lending markets are working properly. And we're providing liquidity to banks and financial institutions who want to use those securitized portfolios as liquidity, as collateral with us to borrow from us. What does that all do? That keeps the credit markets open to consumers and businesses for every type of lending that gets securitized. It's helping make sure credit card loans continue to be made, student loans, auto loans, mortgages, all of that continues to function normally during this crisis. So again, something that we don't get a lot of headlines for, but I think it's an important nuanced argument. And then moving a couple of charts forward. What are we looking at going ahead? And I'll finish here and leave the rest of the time for questions. So we've created, as I said before, some very real-time approaches to looking at the economy. I showed you the weekly economic index that we've created to take a look at what's happening on a weekly basis to the US economy. But we've also created a social distancing index. This is quite fascinating. Using aggregated data provided by cell phone companies, we are able to estimate to what degree Americans are social distancing or not. And to give you an idea of kind of where this index is going, in April, the second week of April, in fact, we actually saw this index hit 100, meaning that was the peak of social distancing. That was when Americans were sheltering in place, staying home, not going out, and keeping social distance. As we've begun to reopen, that index, that went to sort of a negative 100 in April is now back up to a negative 46. So what that means is we are not all the way back to where we were in January in terms of, our interaction with one another and social distancing, but we're about halfway back to where we were. And you can sort of digest from that or impute from that this means economic activity is also improving. In fact, we think this index will get back to a negative 20 by the end of the year. And when we first put that out there, a lot of people thought that we were being a little bit overly optimistic, but the most recent reading of a negative 46 gives us pretty strong reason to believe that negative 20 forecast by the end of the year is very reasonable. And then we're looking at a lot of aggregated private sector forecasts and of course the outlook surveys that I already shared with you. So what are we specifically looking for? What are going to be the drivers to this? Number one, as I said at the very beginning of the presentation, we're looking for the ability for companies to survive under these current conditions. And I'm very pleased to report to you that when we started asking these questions back in March and April, we had a pretty pessimistic response. Most small businesses in particular said they could only survive 30 days to 60 days. And many of the bankers like Gabe that's on the call and Al were telling us they were getting similar answers from their customers as well. But as we continue to ask this question now into June, we're now hearing pretty typical responses as well. I might be able to last another six months, or so under the current conditions. Keep in mind, we've already had 2 or 3 months pass. So not only have they survived the last 2 or 3 months, but now they feel like they can survive another 6. So what does that tell you? That small businesses are figuring out how to survive. They're being nimble, they're being agile. They figured out how to move to the online environment. They've managed their workforces, they've managed their inventories and what have you. They've managed their liquidity, they've gotten access to lending programs where they needed it. And so we're happy to see that the survivability looks to be stronger than we first feared, but this is something we're going to continue to watch. We think at the end of the summer, early fall, there'll be sort of another inflection point where it'll be, we're going to be getting to that 6 month or whatever window, and we're going to see if a lot of these small businesses can continue to hold on. Right now, it looks very optimistic though. And that of course will have an effect on the availability of jobs. And lastly, the one that nobody can really truly predict is consumer confidence. And here, while certainly having a job and all those normal things that affect consumer confidence will matter, perhaps the one thing that's going to impact consumer confidence the most is the state of the public health situation. And I can't emphasize enough that all of these forecasts, all of these numbers I've thrown at you today have that big caveat on there that it assumes that the public health piece of this is being managed effectively. If we aren't able to manage the public health piece effectively, then you can throw pretty much everything out the window in terms of these forecasts, because the consumer won't feel confident to go back out to restaurants, to malls, to sporting events, to theaters, you name it. And that, of course, will have a pretty profound effect on the economy. And so show me how the public health situation goes, and I'll show you how consumer confidence will go. And we believe that things like testing, wearing masks, contact tracing, these are all going to be essential ingredients in order to not only deal with the public health issue and the spread of COVID-19, but more importantly, help that confidence of consumers and therefore businesses alike, so that our economy can continue to recover. So that's perhaps the most important takeaway here, is that this is very much still a public health crisis. And the outcome of the public health piece of this is absolutely going to dictate the economic outcome of this episode. So let me stop there. And I think we have about 14 minutes left that I'll be happy to entertain any questions, Tristan, that you may have been collecting along the way.
Great. Thank you for that presentation. Just starting out, what additional measures can you foresee coming in the next 6 to 12 months to address the economy that haven't already been instituted? For instance, did you see another federal stimulus package being necessary, or something like that?
Yeah, so this one's a little tricky. The short answer is yes. I think it's impossible to sit here and paint any scenario where we're going to be able to recover from where we are today without the additional help of continued stimulus. So from a monetary policy perspective, we're going to continue to do the stimulus that I outlined in this presentation. We're going to continue to keep interest rates low. We're going to continue to keep these lending programs that I mentioned open. The good news is almost all of these lending programs that I listed a few charts ago, none of them have been capped out. None of them have reached their peak in terms of the amount of lending that we are authorized to do. They haven't even come close, but we're going to keep them open anyway, just in case there is a second round or there's more economic stress in the future that we cannot foresee today. In terms of fiscal stimulus coming from Congress, this is a political question, and I know that with the unemployment numbers being better than everybody expected, I think some in Congress felt like maybe they can take a pause on future relief, if you will. And I'm not going to debate what fiscal policy should or shouldn't do, but we do know a lot of Americans are going to lose those unemployment benefits at the end of July. And to the extent that we've not recovered all of those jobs back by that time, then this could be a problem, and it could certainly have a pretty significant economic consequence if Americans are not able to go out and spend money, even on their basic necessities, because their unemployment insurances have run out. Now, there is a question about this additional $600 a week kicker that Congress threw in to the CARES Act. A lot of controversy around whether that should continue. It's a fair debate. From our point of view, we are hearing almost every day, multiple times a day, from employers that tell us they cannot hire back some of their hourly workers because they're making more on the unemployment right now, particularly with the extra $600 than they were making when they were working hourly in their businesses. So we're hearing that consistently. So I do think that Congress has to look at that piece of it and make sure that we're not creating any sort of unintended disincentives for people to work. We want to get people back to work, and we want to make sure that because that's going to be what restores the economy and economic activity. So we want to make sure that we balance the need for further stimulus with also, balancing that with the need for workers and people to go back to work, and not creating sort of distorted incentives that actually keep people from going back to work. And so that's the only caveat I would say about that we have to be watchful for. At the Fed, we don't try to comment too much on fiscal policy, but I think it is important to point that particular aspect out because it's a real issue out there, and it's probably something that's going to slow the recovery of jobs just because people right now are making more money sitting at home. And I think that's something that has to be considered. But absolutely going to need more stimulus to get through this, no doubt.
And Are there any other programs aside from the PPP and idle loans which you'd recommend to our smaller businesses? You talked about some of the other programs that are opening up for the medium to large size businesses.
My best advice to any small business that's looking for potential access to capital or liquidity is to talk to your banker. Bankers know all of these programs. We have done a lot of work to educate bankers and get the information out on all of our lending programs, including the most recent one, the Main Street lending program that I gave you some information on. It's there, it's open. I know $250, $1,000 may be too large for a lot of small businesses, so that program may not be ideal. But banks know what programs are available to them and know how to help small businesses. And banks are giving us feedback all along the way as well. We are constantly talking to bankers and getting feedback on them, not only on our lending programs, but on sort of the state of things in the economy, particularly in the credit markets and the lending markets. And so, it's not impossible. In fact, it's very feasible that you could see the Fed roll out more lending programs if things continue to be stressed or strained, and we see pockets of the economy that are not being serviced by the credit markets. The Fed will step in. That's what we do in a time of crisis, and so you could expect us to continue to have our radar up and to be monitoring the situation. And don't be surprised again if we add some more programs along the way.
Well, that's certainly very encouraging. Something of a particular concern here. Is there anything the Fed can do to target specific industries? Travel and tourism are a huge part of our community and many communities across the country, and I think it's fair to say that they've been affected pretty significantly during this pandemic. Is there anything that does the Fed in any policy things that they do they target specific industry?
Yeah, so the short answer is no. The closest we come to that is mortgages. We do buy mortgage-backed securities in order to stimulate the housing market, but we don't go any further than that to target other specific industries like autos, like agriculture, like the tourism and hospitality industry. And there's a simple reason for that. That's really getting into fiscal policy. Industry policy, industrial policy, or targeting specific industries for stimulus is really the purview of fiscal policy authorities, specifically Congress and the administration. It would really be up to them to do that. And they did do that, if you'll recall, in the CARES Act, they targeted the airline industry. They gave very specific support to the airline industry because they knew right away the airline industry was going to have a difficult time surviving, given the pandemic. And so it would really be up to Congress to enact any specific stimulus support for the hospitality industry in particular. I know it's been discussed. I know the energy sector has also been discussed by Congress, but that's not the purview of the Fed. We are legally not allowed to sort of embark into that kind of space unless Congress were to give us authorization to, like they gave us authorization to do some of the programs that I listed here. But right now, today, that would be beyond our legal scope at the Fed. It is certainly not out of the scope of what Congress can do.
Final one for me, I know we're running out of time here, is what advice would you give those small business owners that are on the call right now moving forward as we try to continue through this pandemic?
I mean, it's kind of difficult, it's kind of arrogant for a Fed official to give small business owners advice because they know their business a lot better than I do. But I think in short, I mean, keep doing what you've been doing. Keep being innovative, keep being creative, keep reimagining your business. I mean, one of the beauties of small business that never ceases to amaze me is just how agile and nimble small business owners are and can be, no matter what the circumstances. And so I would just continue to encourage small businesses to do that. Continue to stay informed too. Stay informed about what programs and assistance are out there for you and help you. One of the things that I've learned during particularly the PPP program was just how many small businesses struggled to get PPP loans because they did not have the technical skills in their small business to be able to go out and apply for those loans. So talk to your bankers, talk to your small business development centers, those technical resources that are out there to provide you technical assistance when you don't know how to do something, or when you don't know, how to go about or how to start to do something. There's all kinds of support out there for small businesses. And I know many of these organizations, bankers, small business development centers, they're out there and they're helping, clients every day. So that would be my advice, is to use all the resources you have, stay informed, ask questions, don't be shy about that, and continue to be innovative and nimble and agile like you've always been, because that's how small businesses survive. The last piece of advice I would give is, we will get through this. It's a very unnatural thing for the economy to be in a recession. The majority of the time, 90% of the time, the U.S. economy is in expansion. So this will end. They always do. And when it does, be positioned to come out of it and to be ready to grow. But in the meantime, continue to be nimble and agile and do what you need to do and use your resources.
Well, we're not out of time here, Blake. I want to thank you again for being willing to come out here and share this presentation and answer questions from our members. John, toss it back over to you.
Okay, Mike, thank you again. As always, you cut through the economics at a high level and gave us exactly what we need. Really appreciate that, and I'm sure people on the call do. I just add on people screen, something that we do is stay connected with they put out a lot of good information on a regular basis. They do virtual meetings, webinars. Anybody can join those, so you can sign up and get into their system. And let me tell you, it's worth it. It's not just academic exercise. There's a lot of really good practical information along the lines of this gave us in the last hour. So with that, we will close it down. And again, I want to thank Blake and Federal Reserve of Dallas for taking this out today. I hope everybody here, at least in Corpus, stays dry and don't go through those intersections that are flooded. Around lunchtime, I saw 4 cars that were already pulled up onto the pavement where they were out of commission. So take it easy out there. Thank you all.
Thank you, John.
Yep, thanks, Blake.